Let's welcome in Amnish Aggarwal, Head of Research at Prabhudas Lilladher, joining in. Amnish, hi, great to have you with us on the show. So let's actually extend the conversation that we were just having on industrials with the analyst at Goldman Sachs, Amnish. Stocks have corrected 7 to 10%, 2 days, sharp reactions coming through in the market. The question is, how do you expect this trade to play out as a lot of investors, institutional family offices, as they maybe tweak portfolios to make them a little more consumption focused? What do you anticipate as this rotation happens over the next few weeks?
Okay, hi. So, Sylvie, there are two factors. First of all, there is a general perception that there has not been commensurate increase in the capex spending by the government. But if you include the allocation which they have made for states, which is in the form of a 50-year interest-free loan, actually the overall allocation is up by 16-17%, which on a base which has seen a 31% CAGR is not a small increase. That is one. Secondly, when you look at, say, on the capex side, there are two parts to it. One is the private sector, and the second is your government capex. And if the consumption demand in the economy is weak, usually the capex from the private sector, it will not be to the extent it was expected. And so rightly, I think as we stand today, the government has given certain incentive in the form of taxation for the middle class, which should boost the consumption going forward. Now, if you look at, say, last 2-3 years in particular, the consumption stocks, barring a few, you can say, purely stock-specific calls, they have been more or less languishing. And there has been a massive rally as far as this year entire capital goods infra space is concerned. So I think now there will be more attention which will be going towards some of these consumption stocks. But when we are looking at some of the consumption stocks, then we need to be very, very careful as to how much could be the jump in the growth for many of these companies. Because in many of the staple companies in particular, it will result in better growth. But how much of the surprise can come? Because, for example, including us, most of the people are factoring in fair bit of uptick to happen in the consumption demand and the estimates in FY26 and 27. Now, whatever happens on top of it in terms of, I would say, increase will be something which will be determining the trend in the medium term. However, if you look at the trend in the consumption, I think many of the consumption stocks in the listed space today, they might not be representing the reality on the ground. And to that extent, I believe that looking at the way the Indian consumer has evolved over the past, say, particularly 5 to 10 years, we would be more confident that there will be increase in the demand coming from the discretionary segment. Now, that might include QSR, that will include jewelry, that will include, say, entire tourism and travel space, even durables. So I think the pockets to play consumption would be very, very different. So that is one. And secondly, one will have to, I would say, wait and watch, even in that space where there is room in terms of valuations. Now, coming to your capital goods, you see the earnings growth or the visibility that has not diminished. Although the kind of margin expansion we were witnessing in many of the companies, so that might not materialize. So is there room for a sustained 15%, 17% growth in earnings for many of these companies? The answer is yes. There was froth in the valuations of many of these stocks, I think, which have got corrected to quite a good extent. So from here on, I think many of these stocks, they will start looking interesting because in the market always it is very difficult to catch both the bottom as well as the peak. So I would say that one should wait and watch for some time because there is too much of volatility centered around geopolitical factors, FI selling and all that. But having said that, I think many of these stocks will eventually or are close to the level where one can start nibbling onto them.
Let's talk about, banks, Amnish. I mean, taking a cue from that, because that's the next big regulatory step, right? Getting these, new guidelines in place come April. As of now, how are you looking at lenders and, what kind of stocks are you comfortable buying?
Banking is one segment where the valuations are not showing any sort of a froth. If you look at all the leading private sector banks today, their valuations may be at least 25 to 30% cheaper than what they used to be, say, a couple of years back. Now, with the consumption demand expected to pick up and the overall, it will actually improve. First of all, the overall credit growth can move up. If there is some reduction in your repo rate, which we are expecting to happen from RBI, I think banking as a sector should do reasonably well from here over the period of, say, 9 to 12 months. Because there is, first of all, no problem with the valuations. The only issue with some of them has been on for example, the credit growth has been slackening from the last 3-4 months. That is one. And the second is on the side of your unsecured lending. So I think unsecured lending also maybe in a quarter or so, I think the worst will be behind that. And I think one should be constructively looking at the banking stocks from here on, particularly the frontline ones like, for example, your ICICI is there, HDFC, Kotak. I think all these banks are looking quite good to us.
Okay, all right. Amnish, thanks a lot for joining in and giving us your view on all these stocks. Looking forward to having a chat with you soon.